Good morning, everyone. Welcome to today's webinar, where we will provide you with a practical guide to blending. This webinar is hosted by Just SA, retirement income specialists in South Africa, and we are delighted to have you join us for this informative session. Today, we will explore blended annuities, which for those of you who aren't already aware, is the common industry term when combining a life and a living annuity in one product. While several providers have begun to recognize the value of blending as an optimal retirement income solution, few, if any, provide advisors with clear, actionable guidance on how much to blend for each client. So over the next 60 minutes, we will tackle this and will offer practical frameworks, easy to use tools, and myth-busting insights to help you and your clients achieve lasting income security without sacrificing flexibility or growth. As Shane mentioned, you are welcome to ask any questions using the Q&A box, and we will answer these at the end. Now, without further ado, it is my pleasure to introduce our speaker for today, Bjorn Ladewig, who heads up distribution at Just SA. Bjorn is a highly experienced expert in the field of retirement income, specializing in life annuities. With a wealth of experience and a very deep understanding of the challenges and opportunities in this sector, Bjorn aims to bring a perspective that is both informative and engaging. Please join me in welcoming Bjorn Ladewig to the virtual stage. Over to you, Bjorn.
Thanks, Jock, and thanks for the nice words. Good morning, everyone. So today we're talking about blending in practice and how you can move from theory to simple application. We're passionate about blending, and I'm passionate about coffee. So today we will be blending these two passions. In our first white paper and various presentations and articles, we speak about the optimal retirement income solution at a high level. But today it's about making that personal and how to customize that for your client. We'll go through the theory that will give you the technically correct answer and then go into a more practical way of blending. And finally, we'll discuss some cognitive biases that prevent people from blending, despite it being the logical answer, and how to counter those. The world of coffee has evolved over time. Just look at this overview from Starbucks, for example. 8 styles of coffee to choose from, and there are many more. And this goes from doppio on the side, cafe americano, espresso, con panna and macchiato, cortado, all the way to latte. Not to mention that you can also add different flavors, use different kinds of milk, add sugar, etc. But what is your favorite blend? And to break the ice a little bit, we'll start with something coffee related. Okay, well, I'm just having some macchiato here. And then we'll continue. So to set the scene for our discussion today, apart from that fun ad, let's revisit what blending is and when it makes sense to blend. So when you consider this list of retirement objectives, it becomes clear that a life annuity or a living annuity covers some, but not all of those. This is why the combination of the two provides the best of both worlds. It's no longer an either-or decision that the client must make. They can have the stability and commitment while also having some variety by introducing the blended living annuity. Blended annuities tick each retirement objective. We're talking about the flexibility to increase or decrease withdrawal rate, comes from a living annuity and a blended annuity. Guaranteed income that will never decrease, life annuity component. Income for life, life annuity component. Protection from inflation as well. And then the financial legacy part also covered, not to mention that on the life annuity component, for the just lifetime income, the income can be enhanced off the back of medical underwriting. Here's a schematic overview of the structure of a blended living annuity. The first thing to note is that a blended living annuity is a standard living annuity, just with the option to include a specific type of portfolio. This lifetime income portfolio so that on the right-hand side, maybe if we can get just a pointer out here, so that component there, that is what differentiates a blended living annuity from a standard living annuity. But that's really the only thing. Because from there, you could have any investment portfolio sitting alongside it. And then very important, one income is withdrawn from the entire solution. So you don't have to manage multiple streams of income, and you don't have to worry about other things happening. That lifetime income portfolio pays a secure income into the cash account, or let's call it the rest of the living annuity. From there, one income is withdrawn, and depending on how that income stream from this lifetime income portfolio compares to what is withdrawn, the remainder may either be reinvested back into the rest or the liquid portion of the living annuity, or it may need to draw from that to supplement. But either way, tax is not paid on this piece before it's being paid out to the client. And the other thing that's important to note is that fees, so including ongoing advice fees, are paid on the entire piece, so the lifetime income portfolio as well as that investment portfolio. So to go with today's theme, let's represent this lifetime income portion as coffee and the remainder of the living annuity as milk. So essentially, how much coffee you add determines the strength of the brew, and that is where personal needs and requirements come into play. So to help one determine when blending makes sense, we created what we call retirement income sustainability maps. This shows the distribution of living annuitants by age, plotted horizontally, and drawdown percentage plotted vertically. We then overlay these two lines. The blue line, which is the safe drawdown rate, and that's taken from an FSCA draft paper on default living annuities back in 2018. These range from 4% to 8% depending on age and sex, and are lower given that you're self-insured and should thus be draw down materially less as a result. And you can read more about that in our first white paper, by the way, where we also unpack a different way of how you can derive and get to similar levels to what the FSCA came. And the second line we add is this coral line, the annuity rate. And this basically is the annual income expressed as a percentage of the capital put into that lifetime income portion. And this, by its very nature, is the maximum sustainable income you can get. This then splits the surface. So these two lines splits the surface in 3 zones, and we'll talk about those zones a little bit more next. So as mentioned, in relation to these 2 reference rates, so that blue and the coral line, the life annuity rates and the sustainable drawdown rates, or safe drawdown rates as we call them, we derive 3 zones for our income sustainability maps. Each dot, so this is just a representation, but each dot presents an actual individual. Zone 1 at the bottom is the safe zone, where a client is drawing less than the safe drawdown rate. Therefore, a pure living annuity with that drawdown strategy is sustainable, and that offers flexibility, bearing in mind that your money could technically still run out, but you're in a safe zone there. Zone 2 in the middle is the risky zone, so that orange area, where people are drawing between the safe drawdown rate and the life annuity rate. In this zone, we see potentially unsustainable drawdown strategies for individuals. And the income solution there is a blended annuity, which can vastly improve income sustainability. But important here is that it does not mean that you have to reduce the drawdown. So within that zone, you can blend increase sustainability, but you don't have to reduce the drawdown. At the top then is the danger zone, where annuitants are drawing above this guaranteed or optimal maximum sustainable income rate. And of course, these drawdown strategies are thus not sustainable. The income solution here would be a life annuity, which can eliminate the risk of running out of money. But despite this, there's still the challenge of how much to blend. How strong does your client like their coffee? Or how strong do they need their coffee? So let's talk about that. So in that blending zone, so that risky zone in the middle of our map, the key question we want to answer is how much to blend. And here, usefully, we can use that same concept of income sustainability maps to answer the question. So in our white paper from 2023, we showed a single case study, 50% blend of how that would work. But today we'll show you a few more examples and then also use that to deduce a framework that can easily be used to determine how much to blend, and will then also make it simpler. So first, a little bit more on the theory, and then we go back to the practical, pragmatic way of doing that. So as I mentioned, we've created some examples to explain how much to blend in a visually and hopefully easy way. In these examples, let's assume that we have two buckets of income, a lifetime income portion, that's that coffee representation, and then a liquid portion, which is the remainder of the blended living annuity, shown as milk. What we've done is that we made the width of the bucket visually to show how much is in each portion, and the level of the water denotes the income rate received or withdrawn from that bucket. So now in terms of the income rate for each bucket, in other words, how much or the rate at which liquid is provided from that bucket, the following should be kept in mind. So for the lifetime income portion, we use the annuity rate, which is the annual starting income expressed in percentage terms of the capital. And then for the liquid portion, we use the safe drawdown rate. As I mentioned, these typically range from 4% to 8%, and we refer to what the FSCA recommended in a draft paper. So let's look at some examples, and what we've done is we've simplified our examples for those two buckets to say, well, let us assume that the lifetime income portion provides an annuity rate, so an income rate of 10% per year, and the liquid portion provides a safe drawdown rate of 5% per year. If you were wondering, these would roughly apply in practice for a 75-year-old couple. That's also the example we used in our previous white paper. For them, roughly an annuity rate would be 10% per year, but the safe drawdown rate is 5%. And then we'll look at three basic examples: a 50% blend, a 75% blend, and then a 25% blend. And we will then use these examples to explain what we call the benchmark blend framework. So here's our first example, really simple example, 50% in each of these buckets. So 10% coming from that coffee bucket per year and 5% per year coming from that milk bucket in combination. And the formula is there, but as you know, it's essentially a weighted average of saying 50% times 10% plus 50% times 5%, which gives you a combined sustainable drawdown rate of 7.5%. Now looking at a 75% blend, and as I warned, the buckets will now get wide and look a bit wonky, but I think it visually just explains what we're saying. Same story here, so 75% times 10% per year plus 25% times 5% per year, which gives you a higher combined sustainable drawdown rate of 8.75%. And then finally looking at a 25% blend, so 25% in the coffee bucket and 75% in the milk bucket. Same calculations, but different proportions. So 25% times 10% plus 75% times 5%, which gives you this combined sustainable drawdown rate of 6.25%. Now, if we look at these three examples in summary, and we started putting some pictures here. So this is about looking at these examples and saying right at the top for the 25% blend, every time assuming the same safe drawdown and life annuity rate, you get that combined income rate of 6.25%. At 50% blend, 7.5%. And at 75% blend, 8.75%. Now, actually, if you consider this table in reverse, so reading from right to left, so you look at what blend percentage would be required, you can quickly deduce that if you needed 6.25%, you should blend 25%. At a 7.5% combined rate, you should blend 50%, and then at an 8.75% blend or combined rate required, you should blend 75%. And this is really what forms the basis of our benchmark blend percentage, which we'll explain next. So as per our examples, the combined income rate is the weighted average of the life annuity rate and the safe drawdown rate. If you had to express this mathematically, you'll see that formula there. And this is what we've had for the examples, a weighted average of those two rates, the weights just being how big or how much is going into each of those buckets. And now this can be transformed. How much of you remember high school maths? You can move it around to essentially then determine, well, what is theoretically, what is the required or the benchmark blend percentage? And this looks as follows then, and that's the formula in the coral bucket. At the top, it's required drawdown minus safe drawdown, and at the bottom, annuity rate minus safe drawdown. So what you may see already, and this is as to be expected, is that if the required drawdown is below the safe drawdown rate, so that top becomes, well, 0 or negative, the entire formula goes to 0. And that's why we also say that in that safe zone, so where you are drawing down below the safe drawdown rate, the theoretical answer is 0%. Similarly, at the bottom, if you're drawing down, if you compare the two, if you're drawing down above the annuity rate, this formula swings to above 100%, and that's why in that danger zone, the theoretical answer is that you should fully annuitize. So as we've covered until now, the theory shows you how much to annuitize. And even though it's not rocket science, it's still difficult to apply because you would need to calculate the formula for which you would need an annuity rate, which you would need to look up somewhere. The required drawdown rate, which is perhaps a little bit easier. There's a simpler lookup table, and it does not change over time. It's maybe an important thing to think about in these times where markets are really doing well. Safe drawdown rates do not go down, and then how much you want to draw down, so the required drawdown rate. So what we've done is to make this even more practical and simplified based on the same theory, but just a lot more pragmatic. So looking at this visually, if we were now to go and map out what this looks like, and you don't need to be able to read the numbers there, the colors give you an indication. But let's say we now take a surface of cells, people, living annuitants, where we again map ages horizontally and drawdown rates vertically. And what we've done is ages in 5-year steps, just to make it easier, and drawdown rates in 0.5% steps. And if we were to then calculate the benchmark blend for each of those, that is what it looks like. So in a way, and maybe just to say here again that the assumptions here is a safe drawdown rate as defined by the FSCA, and then life annuity rates, for which, to keep things simpler, we've used a single female, so as a midway between a couple and a single male with no minimum payment period. The notes are on slides, and you'll get that. And you will now see that that same kind of concept of the maps are coming through here, with 100% benchmark blend in the top left-hand corner and a 0% benchmark blend in the bottom right-hand corner. So in a way, this is already a simplification because we're now bucketing already, but it's still, to carry this around with you is quite a bit. But maybe to just hone in and show for a specific block what we mean when we say that we've calculated it. So zooming in on that block where this is for age 75 and the 7.5% drawdown rate, the benchmark blend is 55%. And that is because if you go and substitute the required drawdown rate, so 7.5% minus the safe drawdown rate for that person, 5.5%, divide by 9.3%, which is the annuity rate, minus 5.5%, then you get a benchmark blend of roughly 55%. So that's just to show practically for a specific cell how that number was calculated. So now what we've done, and I've said that a few times, that we've made it simpler, and this is how we've done it. We took that heat map with all the different blocks and all the different steps, and we said, but is there a way to make it much simpler to not have to look up each age and drawdown level? And it was actually not that difficult to do, and I think you can already visually see that. So what we've done here is we said, well, let's look at 3 age brackets or age bands, and then split them into 3 buckets each. And this was essentially a balance of simplification to as large a degree as reasonable versus maintaining outcomes in line with the theory. And then we landed on this 3 by 3 bucket. And if you map it, you can see it on the slide, done using visual approximation. I'm going to flip back quickly, and maybe you can already see. So this was all the colors, so more grading, and essentially we've just limited this to 3 easy to look up options. So in essence, we've whittled down the menu to 3 common options: latte for those drawing down lower, cortado for those drawing down in the mid-range, and espresso macchiato for those drawing down in the top range. Converting those zones into a lookup table, it would look as follows. So this is, and we've dubbed it our 3 by 3 matrix, but let me work through this with you. So back to the percentage in lifetime income, 25, 50, and 75%, but practically how you would apply this table is to first look up the age in one of these columns. So there's ages 55 to 69 here, in the middle 70 to 79, and finally 80 plus. And then move down that column and look up for the required, or the current, let's call it the current drawdown rate for your client, and find the bucket where that's applied. Once you have that, you can move all the way to the right to read off what that optimal or that benchmark blend percentage is. So using these concepts explained, we have simplified things to what we call holistic retirement income solutions. And we'll talk a little bit about this in this section. Not too long because it's so simplified, but here we go. So these solutions, and we're talking about joint solutions, because it's always a partnership between this lifetime income portion, which is managed by Just, as an example, as a lifetime income provider, and then the investment or asset manager, which manages the growth portion or that liquid portion. And it's this partnership which gives you, on the one hand, a secure income for life that you can depend on at a good income rate, and I mentioned before, at quite a bit higher than a safe drawdown rate. And then the rest of the investment portfolio, which provides that growth element, that capital growth part. And in combination, you're getting literally that best of both worlds. So the secure income as well as the capital growth portion. And this is innovative in the sense that it provides a combined approach in a curated, simplified retirement income solution, and that harnesses the best of both of those sides. I've shown the structure before, but just maybe to show it again. So one living annuity, one blended living annuity, and we work with a range of partners there. Alex Forbes, Alan Gray, Citadel, Signia, 274, and PPS. So that would be their blended living annuity, with the coffee provided by Just, the milk provided by any of the funds that you could select, and this could be made simple as well. And in that one combined solution that gives you the desired blend and your desired type of coffee. And this works really in two simple steps. One can maybe add a third, and I'll mention that, but the two simple steps are really just relative to those two portions. The first one is which investment portfolio to use. And this could follow your normal mantras or styles for picking which investment portfolios to use. So this could be investment risk profile or risk tolerance or time horizon, different styles, anything that you would typically apply to make that selection process easy and understandable. It could be a model portfolio, it could be a bucket approach here, although already mentioning bucket approach, there are perhaps better ways to combine the two, but this could be your standard approach. But importantly, because the lifetime income portion essentially reduces the risk or the strain of what income is needed from this portfolio, you can essentially go ahead and profile this without worrying too much about the drawdown rate. And I think this is something worthwhile hovering on, because that's why the combination makes so much sense. So we've said a few times that the lifetime income portion provides higher income rate, and in combination, you then know if you pick the right combination, you'll get the optimal, you'll get your required drawdown rate at an optimal balance across the two that you know by definition is sustainable. Because of that, you know that essentially from the investment portfolio, you're only drawing down safely. And you can thus go pick your investment portfolio or model portfolio or style without too much worry about drawdown level. You can basically assume they're drawing down safely for that. So that's step one, not our expertise. That's over to you and asset managers and DFMs out there to make this step as simple as possible. Step two is then literally just what we've been talking about until now, where you look up from that 3x3 table, you look up what the optimal mix is of the two. I mentioned already, look up age on the columns and then drawdown, required drawdown level on the rows, and that gives you to the right-hand side of the table, it gives you how much should go into the lifetime income portfolio. Already this table, you may have seen slight variations on this. We're working with a DFM Miton Optimal, for example, where they're using a slightly different variation of that. And that's also good because it still is in line with what provides better outcomes. But you may see some some customization across the industry on that. But either way, making things simpler for advisors and clients to blend, because that has been a major stumbling block. Not to mention some of the other barriers that we have found in all our discussions around blending that we've started in 2017 already. So this section will talk a little bit about what these barriers to annuitization is or are, and then why they exist, and they're based on behavioral or cognitive biases, the myths around them, and then also how we can address them, how we can bust these. So the final section for today will go into some of these biases in more detail. So the first one is present bias. And what we mean with that is, and every time we'll say the description on the slide, so you'll see this is the tendency to prefer immediate rewards over larger delayed rewards. So this is like saying people would prefer getting 50 Rand today instead of 100 Rand next month. Probably also called instant gratification. And that is real, that's been proven, and we know that from what we see with others and ourselves. The resulting perception or myth this causes within the annuity or the retirement income solution decision-making world is that individuals may choose to defer annuitization, and this is because despite higher cost of doing this later, they value the immediate benefit of deferring, which is around flexibility and having full access to capital. So on the myth-busting side, let's talk a little bit about why deferring annuitization does not make sense. But let me say this to begin with. Yes, life annuity rates, or guaranteed annuity rates, do go up by age. And this is simply because the remaining life expectancy generally shrinks as you get older. The thing, though, to consider is that if you consider the math or the theory, it's actually more expensive to defer annuitization. And the reason for that is twofold, and we've put them down here. And you'll see that we compare two different streams. So imagine either immediately annuitization, so those coral bars right now, versus deferring for 5 years, and then annuitization. And here you may already see that at age 65, for example, for a male age 65, life expectancy is 17 years. So that's 17 bars that we put down there. Now, the problem with deferring annuitization is it's expensive or more expensive for two reasons. The first one is if you defer for 5 years, you still have to draw down income for that 5 years. It does not go away. You don't just bank it. Then when you annuitize at age 70, and that's the gray bars, by that time, because you've now survived 5 years as well, your remaining life expectancy may reduce, but your overall life expectancy is longer. 2 years have been added, as you can see here, from those gray bars. And that's really the two reasons why deferring doesn't make sense. So theoretical, when to annuitize is now, but then as we have been saying, it does depend on where you are on that map. In other words, can you afford to draw down safely, as an example, or must you rather blend or fully annuitize? The next bias is called loss aversion, and this is the tendency to prefer avoiding losses rather than acquiring similar gains. In a life annuity, the perception is that when you die earlier than expected, you will lose out. That is true. The pooling benefit of annuities do mean that those dying sooner than expected subsidize those living longer than expected. But compounded with that is that we know from having done various just retirement insight surveys that elderly South Africans materially underestimate how long they're going to live. 5 to sometimes 10 years. And this is and that's the graph we show at the bottom. You can look up at this in more detail in our Just Retirement Insights, but typically people underestimate how long they're going to live. On countering this, there are two things to consider. The one thing is, because of this bigger concern of dying today and tomorrow, people do firstly underestimate their life expectancy. And then secondly, forget that not only is life expectancy longer than what you'd expect, there's a 50% chance of living longer than that life expectancy. That's literally the definition of life expectancy. So to think about this is that life annuity is not taking the risk of losing your money. It's a form of financial security rather than a restrictive investment. And then if this remains an issue, remember that there are capital or death benefits that you can add to a life annuity, and that's around a minimum payment period or guarantee term or a spouse's benefit. On to the next behavioral bias, which is the endowment effect. Here, this is the tendency to assign higher value to something simply because we own it. And the practical example is owning a coffee mug rather than buying it. Because you have it already, you actually attach more value to it than what it's worth. And how it actually culminates is that, especially with a living annuity, there's a greater sense of ownership, given that the living annuity is your own flexible investment and the full capital is available. And that means there's an unwillingness to transfer a part to a lifetime income component which cannot be surrendered. Now, to counter that is to explain that within the blended living annuity in particular, you still own the entire living annuity. So it's that lifetime income portion as well as the remaining or the liquid portion. The flexibility thus remains, and it is similar to a pure living annuity. And as I mentioned just now, death benefits can also be added to that lifetime income component. Yes, it reduces the starting income the stronger these benefits you add, but you can add two of them, and it's a spouse's benefit, which means that the income is still paid to the spouse who's still alive at the time of death, and then a minimum payment period or a guaranteed term, which literally just means what it says is that for a minimum period, income will be paid no matter what. And those two can also counter that sense or that feeling of losing everything. Although I should add at this point, especially when you're considering people living annuitants who are drawing down above safe drawdown rates, you actually rather want to fully harness the income rates that you can get from this lifetime income component. That's really valuable. Yes, it may stop upon death if you don't add these other benefits, but remember that the point there is that it's to make sure that income is sustainable for that life, for that couple, and that is very valuable. And we often see people actually emphasize or put more value on legacy, and what then typically happens is they try to do that within a living annuity where they're drawing down at unsustainable rates, money runs out, and then they, quite ironic and sad, they end up becoming dependent on exactly those people who they wanted to leave a financial legacy to. The next behavioral bias is called ambiguity aversion, and here it's where people avoid taking bets or taking options with unknown probabilities, even though they may have the same or better expected value. And where we see this particularly is around the type of increases picked on lifetime income. There are a few styles. I'll quickly mention them. As you may know, there are level annuities, so no increases. You then get fixed escalating annuities, and this is our example here. For example, 5% per year. You then get inflation-linked income, and then finally you get what we call our just lifetime income, and those are with profit annuities, or better explained, they have investment-driven increases. You may find that they're back in vogue. They haven't been for a few years now, and the reason for that was around starting incomes, but then also this ambiguity aversion, where people rather took something where they have a known or a perceived known increase, and I'll explain now why I mention that, of 5%, as opposed to something that could either give inflation increases or something linked to the returns of an underlying fund. Now, why we say is that it's a perceived certainty only is you buy these incomes generally to match a stream of outgo, which are generally related to inflation. You may argue different levels of inflation, but certainly inflation. And because of that, 5% may sound certain, but what is uncertain actually is what your expense requirements will be in the long term. And we are really talking about very long terms here. As a reminder, there's roughly a 10% chance of a male age 65 reaching the age of 95, and a female age 65 reaching the age of 100. So for both of them, there's about a 10% chance of outliving that. And because of that, we're talking generally about 30 to 35 years of planning horizon. And with that, we just do not know if 5% would be enough. Yes, at the moment, actually inflation levels are low, but we know that looking back, and maybe looking forward as well, there have been many years where inflation has been above 5%, and this could happen or not. And that's the point about what we're talking about here. Whereas if you were to pick a lifetime income which gives inflationary increases, or something that's driven by investments, which you would expect to outperform inflation in the long term, that would actually result in better outcomes. But because of this behavioral bias and ambiguity aversion, people often pick what they perceive to be certain. Then talking about framing effect, I think that's our second last behavioral bias. And here what we can say is that decisions are influenced by how they're presented. As maybe an everyday example, for the same surgery, a 90% survival sounds a lot better than 10% mortality. So depending on how it's framed, does affect what choices people make. And this, I think, particularly applies to living annuities, which are more modern products than life annuities, which have been around literally for millennia, life annuities. And yes, as we've discussed before, each of those offer their benefits. But because living annuities are seen as more attractive, and people do choose that more because of this bias. This has also been made worse by a few other things, not to mention advice fees, which have somehow skewed it, and that is because advice fees on a life annuity is capped at 1.5% upfront, whereas in a living annuity you can earn an ongoing fee. You may have heard, or I mentioned earlier today, though, that with a blended living annuity, the playing field there is leveled in the sense that the ongoing advice fee is payable on the entire market value. So to counter that, to just speak to what we've been talking to till now, is decisions should rather be based on which zone you're in on that income sustainability map. And I've mentioned before, so in the safe zone, pure living annuity, risky zone, blended living annuity, danger zone, a pure life annuity. Or differently put, that benchmark blend or that simple lookup table that we've got, where if you're above that, it implies 100%, or if you're below that, it implies 0%. Finally, and I think this is actually quite an important one because it addresses a few things. This bias is called money illusion. And this is because people think in nominal terms rather than real terms. And that's particularly in South Africa a big problem because inflation rates are generally higher than in the rest of the developed world. So this, as an example, is why people feel richer with a 5% raise even though inflation may be 4%, than, for example, getting a 1% raise if there's no inflation. I think you'd agree that the first example does sound better, and we can buy into that. The second reason I think is, or an example, is that we all grew up with this narrative of being able to live forever off interest from your bank account. This is false. Let me just say it outright, because if you withdraw that interest every year, the remaining capital erodes with inflation, and the interest itself, so your income, also erodes with inflation. So this bias leads to people believing that they can withdraw the nominal returns achieved in their living annuity. And that's false. So maybe just to bust that myth, a schematic here which shows that as your money grows, you can only actually withdraw the real return. The reason we say that is that if you take that out, then the remaining capital would have grown with inflation, and therefore the capital retains its real value, and you can safely draw down this. And this is, by the way, why you'll see that safe drawdown rates are around that 4 to 8%, 4% for longer terms, because that's typically what you'd expect from a well-diversified portfolio. So 4% real return, so you can draw down 4% eternally, or it gets a bit higher, at least the older you get, because your life expectancy starts shortening. So what have we learned today? So the first thing is that blending living annuity provides the optimal balance between capital growth and income security. Then by applying practical frameworks, advisors and clients can determine the optimal blend percentage in a simple manner. So that's that 3x3 matrix. Behavioral biases, and we spoke about a few of them, they hinder effective and logical decision-making regarding annuitization. We've given you some help on that. And then finally, we've made blending simpler in a holistic retirement income solution, where you really only need 2 steps: pick the investment portfolio, look up how much to invest in the lifetime income, and that will give you a balanced approach to achieve the optimal balance between capital growth and income security. In essence, as I mentioned, we've whittled down the menu, our coffee menu, to these 3 common options: latte for those drawing down lower, cortado for those in the mid-range, and finally espresso macchiato for those drawing in the top range. We've been talking about our previous white paper. Well, a lot of what we've said today just set out very nicely. We have summarized in our latest white paper, and this offers a practical framework and easy to use tools. It explains this blending concept, what an income sustainability map is, and then finally these behavioral biases, we address those. And that you can all read in our white paper, which you can download by scanning this QR code. You will receive the packs as well, where the QR code will be in. But please go ahead and follow that link. That will take you to our website, from where if you fill in a basic form, then we'll send you the white paper. Okay, cool.
Thank you, Bjorn, for sharing your expertise and insights on the practicalities of blending retirement income solutions. I'm trusting this presentation has provided valuable information and practicable strategies to the advisors to help you make informed decisions for your clients' retirement income planning. So I think it would be prudent for us to now go and look at some of the questions that came through during the presentation, Bjorn. And I'll pass some of those on to you, and I'll try and answer some of those myself. So the first question is, are the drawdowns spoken about in the presentation net of costs?
Good question. So these are actual drawdowns as calculated, so income divided by market value. So they are, let's call them gross drawdown rates, meaning what income you'll receive. They are gross of tax though, so you'll still have to pay tax. But they've been calculated in a way with taking costs into account. Why I say that, if I consider the FSCA table, and we have insights into how those were derived. They definitely took costs into account, both from the living annuity side itself as well as the asset side. So when we talk about, I mentioned that 4% real return is sustainable in the long term. That would be a 4% net real return. So that's what I can say about costs. So they were taken into account to calculate these safe drawdown rates.
Thank you for that, Bjorn. Another question for you perhaps to answer. Does the Just Blending tool show these suggestions automatically?
Yes, so what we have done for our Just Blend tool, and I nowadays refer to that as the Pro version because it very usefully gives an overview of income and your capital or death benefit situation. It does immediately show your precise calculated benchmark blend. When you open it up, there's actually a slider where you can see different scenarios for different blend percentages, but it already gives you that guidance to say this is your benchmark blend calculated, and that will be in line with that. You may recall the more colorful heat map with all that different percentages. It will be an exact calculation, well, within the nearest 5%. So yes, it is on our Just Blend tool, which we have available via various of our platforms.
Thank you for that, Bjorn. And then two questions that are slightly related to one another. The first is, does Just offer its own living annuity? And then the second one that links to that, please repeat the platforms where Just is available.
Okay, great. Good questions. So no, we do not offer our own living annuity. We are proud to say that we partner with a few platform providers where we provide, and we anecdotally say this like the Intel inside of your laptop. So we provide that lifetime income portfolio portion on the blended living annuity, which is a normal living annuity. And that is then available through 6 platforms that we work with. Alphabetically, that would be Alex Forbes, Alan Gray, Citadel, PPS, Signia, and then 27.4. So through all of those platforms, you can blend, meaning a living annuity or a lifetime income portfolio can be added to a living annuity at those percentages mentioned.
Thank you, Bjorn. Ladies and gentlemen, that concludes our session for today. So thank you once again for joining us. We appreciate the crucial role you play in helping clients achieve a better later life. The recording will be made available, and once CPD points have been confirmed, we will communicate this to you and issue you with a certificate of attendance. If you have any questions about this, please feel free to send Michelle a mail. As always, our team is also available to help with queries or bespoke scenarios you may encounter, so do not hesitate to contact one of us for any quote request or to find out more about our tools and resources. We look forward to engaging with you further. Have a wonderful day. Goodbye.